I would now like to move to our first keynote speakers, as was already mentioned by Jose Manuel. So I'm very, very glad to introduce Ms. Carolyn Rogers, who is the Secretary General of the Basel Committee on Banking Supervision. Mrs. Rogers was appointed to the Secretary General role for the Basel Committee in March 2019, and she took up her duties in August 2019. So in this capacity, she also serves as the chair of the committee's policy development group. Mrs. Rogers has 20 years of executive management experience in the financial services industry, having worked in both the public and private sector. Prior to joining the committee, the Basel Committee, Mrs. Rogers was the Assistant Superintendent of Regulation at the Office of the Superintendent of Financial Institutions in Canada, and served as this institution's representative on the Basel Committee. So the topic of Carolyn's speech today is emerging risks in the banking sector, impacts, risks, and opportunities. So this also promises to be a very thought-provoking introduction to our academic sessions. So please, Carolyn, floor is yours.
Many thanks, Ollie. Can you hear me okay?
Very well, thank you.
Okay, good. I had a little trouble hearing Jose Manuel, so hopefully my internet connection holds up. Well, let me first start by saying hello to everyone. Good afternoon. And also many thanks to my colleagues at the EBA for this kind invitation. I'm very pleased to be joining you at this year's policy conference. I think if my memory is correct, we were meant to be gathering in Paris, which of course would have been lovely, but I'm glad we were able to go ahead and gather virtually today. So I looked at the agenda this morning and saw the title of my speech match the title of your conference, which I suspect we probably did before the speech got written. So I hope the speech I'm going to give to you will still meet the mark. But what I want to focus on really is the relationship between research and researchers and the work of the Basel Committee. So it goes without saying, but let me say it anyway, that research is critical to the work of the Basel Committee. Since its inception in 1974, the work of the committee has been grounded in two key analytical principles. First, policy and supervisory initiatives must always be based on rigorous conceptual and empirical analysis. And second, the need to engage extensively and transparently with a wide range of external stakeholders, including, of course, academics. Unlike with global pandemics, self-isolation is not an option for effective policy making and supervision. Whether through conferences like the one today and tomorrow, working papers, or ad hoc outreach events, the committee places a very high value on the input of researchers. So today I want to talk about the important relationship between the committee and research. I'll start by reviewing some past examples of how research has contributed positively and at rare times somewhat less positively to the work of the Basel Committee. I'll then turn to some topical initiatives on the committee's work program which would benefit greatly from ongoing input from researchers. So I said at the outset, research has always influenced the design and the evolution of the Basel framework, and this is a source of some pride for us. Since the early days of Basel I, the committee has always relied extensively on analytical inputs from its members, including in-house researchers at central banks and supervisory authorities, and on external academics. I think of research as a key ingredient in the policy-making life cycle. Starting with the rationale for new or changed policy, this is often spurred by research showing cracks or deficiencies in the current system. Research then helps us properly frame out the objectives of our policy work and feeds the design process. It helps us understand and measure trade-offs, and it helps us calibrate standards. Next, once a policy is designed and subsequently implemented, research helps us measure its impacts, both those intended and unintended. This gives us that feedback loop that helps with evaluation and, where necessary, adjustments and fine-tuning. So indeed, it Effective policy making needs to draw on research at every stage of the life cycle. It keeps us disciplined, evidence-based, and prevents what can be that knee-jerk reaction to a one-time event or a particularly vocal stakeholder. Now let me highlight a couple of notable and recent examples of the important role of research in the committee's work. First, I'd come to the finalization and the calibration of Basel III. The committee conducted a wide range of analysis on the short and long-term economic impacts of higher capital and liquidity requirements. We also conducted a series of top-down assessments of the optimal level of capital in the banking system. These studies drew on state-of-the-art research by our own members and by academics. It's worthwhile to point out that we didn't conduct this work as a sort of rubber stamping exercise or an ex post rationalization of the Basel III calibration. These studies provided the foundation for subsequent research on optimal capital and liquidity requirements. Indeed, a recent review of literature by the committee found that the range of estimates for optimal level of capital requirements is either similar to or higher than originally estimated by the committee. And the COVID-19 pandemic has demonstrated unquestionably the benefits of having a resilient banking system underpinned by healthy levels of capital and liquidity. Second, research played a critical role in the design of the Basel III macroprudential framework. The extensive literature and research on credit cycles and the interconnectedness of the financial system provided the intellectual stimulus for the committee to incorporate a macroprudential overlay to the framework. And it fed directly into the design and the calibration of the countercyclical capital buffer and also the framework for systemically important banks. And again, these innovations and the buffers have proved an important tool during the COVID-19 crisis for banks to be able to absorb shocks and maintain lending to the real economy. But, and there's always a but, there have also been a few instances where insights from research may have been taken on board the regulatory framework either prematurely or overzealously and with less favorable outcomes. Perhaps the best example of this was the wholesale adoption of internally modeled approaches, starting with the market risk framework back in 1996. Buoyed by enthusiasm for apparent advances in modeling, the Basel II framework provided much greater discretion for banks to calculate their capital requirements. This shift was motivated, well-intended, by the objective of greater risk sensitivity and the belief that using internal models for regulatory purposes would incent banks to improve their own risk management systems. In practice, and with the benefit of hindsight, the added reliance on internal models opened up a bit of a Pandora's box. The great financial crisis exposed the many fault lines in the underlying assumptions about portfolio correlations and volatility-based risk measures. And it turns out that granting too much discretion to banks provides incentives to underestimate risk rather than improve risk management. More generally, we found that capital requirements for risk categories and asset classes with insufficient data and fat tail risks really can't be modeled reliably enough for prudential purposes. The excessive variability in banks' modeled capital requirements, evidenced by the hypothetical portfolio exercises conducted by the committee, another good example of research, ultimately undermined the credibility of the risk-weighted capital framework. So what did we learn from this experience? I would say first, a regulatory framework that relies on multiple metrics will undoubtedly be more robust to arbitrage and to erosion over time, as each measure offsets the shortcomings and the adverse incentives of the others. The final round of Basel III standards are designed with exactly this principle in mind. The second lesson is perhaps even more important, though, and that is that a little humility and skepticism are always helpful in policymaking. Even with healthy doses of good research, policymakers face uncertainty when designing standards, so it's always optimal to err on the side of prudence. And this is why Basel III constrains the use of internally modeled approaches. And third, and perhaps most importantly, strong supervision is an integral complement to the regulatory framework. As a colleague of mine once said, you need seatbelts, you need airbags, you need speed limits, but you still need cops on the road. Looking ahead, how can research continue to assist the committee in its current work program? I'd highlight two areas that are particularly ripe for academic input. First, the committee has a comprehensive work program to evaluate its post-crisis reforms. We're conducting a range of empirical analysis based on the experience over the past decade and more recently based on the current crisis. The aim is to evaluate the extent to which our reforms have achieved their intended objectives, the interactions among the reforms, and whether there are any gaps or significant unintended consequences. This work is, as it should be, agnostic to the final outcome. It's driven by empirical analysis on the Basel III reforms that have been implemented to date. And this is where academic research is crucial to provide a rigorous basis to the conclusions and to help counter the noise emanating from vested interest. If left unchecked, some of the popular narratives can go viral and ultimately undermine the resilience of the banking system. Recall the experience we all saw with Basel II. With this in mind, the committee is seeking to appoint academic advisors to assist our evaluation work. We posted a notice to this effect on our website last week, and I'd encourage anyone that's interested to submit nominations for these roles. Second, as the financial system continues to evolve, and I think this is the particular focus of your conference, the risk environment will change, and the committee will need to draw on a wide range of research to help inform its supervisory and policy initiatives. This includes work related to digitalization of finance, the role of banks in the future, climate-related risks, CBDCs. So these are all areas of new and emerging risks and new and emerging research. In these areas, we'll need to cast a wide net to draw on insights from fields beyond finance and economics. Policymakers and supervisors can and should learn from anthropology, organizational behavior, natural sciences, to name just a few. Tackling some of these emerging risks and trends in the banking system will require insights from multiple disciplines. Lastly, while I've focused so far on how researchers can help the Basel Committee, I'd be remiss if I didn't also take this particular opportunity to ask how the committee can help researchers. A notable area, of course, relates to data. As many of you know, the committee collects a lot of very granular data on bank balance sheets and various regulatory items as part of its Basel III monitoring exercise. While we regularly publish analysis that draws on this data, the committee is keen to make some of the data available to external researchers as well. We recently set up a formal process for interested researchers to request the use of this data in response to calls for research proposals. Greater use of this data will be of mutual benefit to researchers and the committee, and will ultimately deepen our regulatory and supervisory insights. So let me conclude where I started by stressing that research has always been, and will continue to be, a critical input to the work of the Basel Committee. And looking forward, we'll continue to draw on research insights to inform our evaluation of Basel III reforms and to assist our supervisory and policy-making initiatives on topical and technical issues in emerging risks. I'll stop there and would be very pleased to take some questions.
Thank you very much, Carolyn, for these very important remarks and very nice overview of the role of research in the policy work and in the supervisory work and the design of the new regulations. Now, I would invite questions from the floor. The easiest way for you to pose questions to Carolyn would be to write them in the chat box. So if you have anything related to the speech or anything else that you want to ask related to this topic area, now the floor is yours. I could maybe meanwhile go forward with one question about the bank's digital strategies. essentially, so the banks have been involved in implementing these digital trust strategies already quite some time. So this is really nothing new. It's been understood already, specifically after the financial crisis, but even already before that, the digital transformation is going to be very important for the future of the banking. Now, the ongoing pandemic crisis has, of course, vastly accelerated this process, and many banks have found themselves in the situation where they probably would have had to move into this territory perhaps faster than what their comfort zone would have allowed. Would you see any risks in this process, in this moving to very fast moving into the, or whether it's actually an opportunity that we actually forced ourselves to take this necessary step now, and obviously there will be no return after that. But interested in hearing your thoughts about this.
Yeah, thanks, Ollie. It's a good question. I mean, I think the answer is yes and yes. Yeah, yes, there's risks, and yes, there's opportunities. So necessity. I think you said it well at the beginning of the workshop today that necessity is the mother of invention. We've all had our comfort levels and our abilities when it comes to technology stretched, and for the most part, it's an experiment that has worked well in most cases. But I think certainly a lot of the issues that are related to technology, to fintech, to digitalization, and the many things that go along with it, the thing that comes to mind for me is large-scale outsourcing. Those were risks that were on the radar of the Basel Committee well before the pandemic, and as you put it, really the only real changes, a lot of them have been accelerated. So, will the risks increase or decrease with that acceleration? I mean, I don't think that I have a firm view on that yet, but I am glad that these are things that we had turned our mind to before the pandemic.
Thanks very much for that. We have two questions on the chat box. I will read them out in the interest of everyone. So there was a thank you for your presentation. I have a question regarding the role of research and data that you make available. Do you also provide the possibility to discuss and publish research with the BIS? So obviously it comes from somebody with keen research interest.
Yeah. So I think both the BIS and the Basel Committee, like we have the Basel Committee has a research task force, and they hold a conference, I think, similar to the one that we're participating in right now. So I think if that's what you mean, is there an opportunity to bring forward research for discussion that's focused on the Basel Committee's work and data? Yes, there is.
Very good. The next question is from Filippo Bartoli. So, dear Carolyn, thanks for your speech. I'm a trainee at the SSM. Do you think that the effects of the excessive discretion they left to banks by Basel II would have been somehow offset by better supervisory processes at the time, I believe?
That's a good question, like, especially for a trainee. Look, I think that one of the challenges, but at the Basel Committee level and at the level of all of our members is the balance between rules and judgment. And by judgment, I mean sort of the supervisory overlay. I don't think the discretion that we gave to banks in modeling in Basel II, I think it would have been difficult to offset that by discretion by supervisors. We have Pillar 2 built into the framework, but I think it's difficult to put supervisors in a position of having to keep up with problems in Pillar 1 through Pillar 2. I don't think that's a good way to approach it. So, I think some of what we've done in Basel III in the reforms that have been implemented so far help, and I look forward to implementing the final set of reforms, because I think those are an important thing to that balance between discretion and rules.
Thank you. We have a next question from Piers Haben, who's a director here at EBA. You emphasized the humility and skepticism, which I fully support, but is there a risk that we inadvertently prevent an important and beneficial new technology emerging as a result? If so, how should we manage that risk?
Yeah, I think that is a risk, Piers. And Jose Manuel talked about this too, that we need to try as much as possible to be to look past the method, the technology platform or the technology, and look at the underlying risks of a new product or a new delivery mechanism or even a new institution. So I think one of the qualities of good supervisors is they're disciplined thinkers. And so I think that talent has to come to bear as we think about technology and what it brings to banking, because there is lots of innovation. There's lots of benefits and innovation that comes from it, and we have to be careful not to squash that by regulation that isn't necessary.
Thank you. We have a next question, which is a slightly policy biased question. So I should maybe stress in this context as well that this is a research workshop. So any comments made by participants and policymakers in particular, like Carolyn, in this context should be taken with that in mind. So we are not here about to make any binding policy comments or policy statements, but rather this is an environment for thinking and provoking ideas. But with that in mind, the question is, banks currently are taking responsibility for financing the industry. However, we will see losses in their loan portfolio coming up. Are you in favor of building a kind of bad bank for banks to get rid of some of these distressed loans?
So I got asked this question this morning by a journalist. This is a proposal that Andre Enria has put out for the Euro area, and I'll answer it the same way here. I think Mr. Enria is doing what every good supervisor does, which is looking ahead and putting ideas on the table to prepare for the future. A good supervisor sort of hopes for the best and prepares for the worst and thinks ahead, puts ideas out there. I think that's exactly what he's doing. That's what good supervisors do.
Thank you. And the next question is from Ricardo Arroja, saying, Dear Carolyn, I have read about bank CEOs arguing that Basel rules, and notably RWA factors, have led many banks to lose sight of the main economic purpose of banks, i.e. financing the real economy. Do you agree, and should RWA factors change? Interesting question.
So look, the job of a bank is to lend and provide services to the economy through the cycle. Not just when times are good, but through the cycle. And so the Basel rules, including the risk weights, are designed to make sure that banks stay robust through the cycle. So they don't lever up when times are good and constrain credit and deleverage when times are bad. I think the first few months of the COVID pandemic have proven that additional capital and liquidity buffers support banks in playing that role.
Thank you very much. I have one question here about, okay, we have seen significant activity from the regulatory community in the area of operational resilience, such as G7, Cyber Expert Group, Basel Committee Principles of Operational Resilience, recent legislative proposals from the European Commission, etc. So do you think more needs to be done given the fast pace of the technological adoption and the respective growing IT-related risks?
Yeah, I think the Basel Committee has 2 papers out right now in the area of operational resilience, and we've got an active consultation going. So I think that's a clear signal from the committee that it's time to refresh our thinking in these areas.
Very good. And then I think we are arriving at the final question, at least on my list. This is an interesting thing. It combines actually 2 topical issues. Who do you think should lead the innovation and digitalization process in sustainable finance? Banks or fintechs? Are they competitors or complements?
You're right, that combines a few things. So the innovation and digitalization process in sustainable finance. So I guess I'm not sure I clearly understand the question, but I think the way I would answer it is sustainable finance is going to take a pretty global effort from everybody involved. So I think there's a role to play for fintechs, there's a role to play for banks, whether they're complementary or competitive, I think that remains to be seen. Hopefully they'll be complementary. Yeah, I'll leave it there.
Thank you. We have still a couple of minutes left. Yeah, I should just mention in this context that obviously ESG and sustainable finance is also another area where we, the EBA, but also in the context of the international colleagues in the Basel Committee are very much involved. So lots of things are happening in this area, and I think it's of course interesting when the technological issues come to interplay with this ESG. So there will be lots of things for researchers as well to do in this area, I believe.
Absolutely, yeah.
Then we have one more questions coming. Bank policy regulation leans towards borrower-based ratios, loan-to-income caps, debt service to income, loan-to-value caps. Do you think these policies are pro-cyclical, and in particular loan-to-value and income-related ratios?
Are they pro-cyclical? Well, I mean, this debate around procyclicality is one that sort of comes up cyclically. So, I mean, the way I tend to look at this is the business that banks are in is inherently cyclical. We know that we go through financial cycles, we know that we go through credit cycles, and we know that primarily with the benefit of good solid research, we know that those cycles are at least somewhat predictable and have somewhat predictable impacts. So I think the other thing I have observed is that when times are good, we often hear a plea for more risk sensitivity in the regulatory framework. And when times are bad, we hear a lament that there's too much procyclicality in the regulatory framework. And I think the fact is that those are sort of 2 sides of the same coin. If you want a high level of risk sensitivity, you will, I think, almost by design build in a certain amount of procyclicality or at least cyclicality. So, but this would be a great area for more research.
Thank you. I realized that I overlooked actually two questions here meanwhile. So we have one from a colleague from ACPR, the French regulator. Do you think that in some instances finding the right balance between financial stability considerations on the one hand and profitability on the other hand could be difficult to achieve? Some business models could be made less diversified if banks decide some businesses are no more profitable, or they may move to other jurisdictions. Beyond what I learned from research, to which extent can banks' point of view be taken into account in the design of regulations or standards?
Well, I mean, on the very last question, I think banks' point of view are well taken on board in the design of regulation and standards. The Basel Committee has a very robust consultation process, and believe me, we hear a lot from banks in the design of regulatory standards. But I think if I understand your question, you're talking about sort of the balance between banks' need to provide, perhaps not necessarily profitability. Are you thinking more shareholder return versus the bank's stability concerns? I think, I mean, fundamentally, a bank that isn't profitable in the long term anyway will not be stable. And if we have many banks that are not profitable and not stable, then the overall system is also not stable. So profitability really is a precondition for financial stability in the banking sector. But if I understand maybe, or I'm assuming that maybe the underlying question is really more around banks being highly profitable or providing high levels of return to shareholders. And there again, I think it's sometimes presented as a trade-off, but I view it as a bit of a false trade-off. I think what is fundamentally good for the shareholders of banks is also fundamentally good for financial stability in the long run.
Thank you very much. We are approaching the end of the time of the session, so I will take one final question, which is here on the list. Would you agree that regulatory prudential requirements and supervisory practices are lagging behind the technologies being implemented in the market by lenders? And is there a way for the regulation to be proactive in this sense?
I agree that it's a difficult thing to keep pace with. So I think Jose Manuel talked about this right now. There's a lot of consultation going on what we call the regulatory perimeter. Most regulators are given a remit by their legislators. Typically that remit is defined around a certain type of institution or product. Sometimes it's defined around an activity. But it generally isn't up to a regulator to decide who it regulates or where its regulatory perimeter is. That's typically a question for legislators. And legislation can be something that's slow to change. We know that. So I think right now regulators are working actively with legislators to try and help them understand the limits of the existing regulation as it relates to some of the new business models and products that are out there. You're hearing lots of discussion around the non-bank financial sector and whether or not it's adequately regulated or supervised. So I think these are live questions. Would I say we're lagging right now? I think that's probably a fair assessment, but I think we're on our way to catching up.